Probably the biggest thing with any marketplace, or even just if you think about people in their own individual circumstances, is uncertainty drives concern, and that's when people start to be again, uncertainty around that, and they don't.
Absolutely.
Don't like it. No one likes it, so markets react to that uncertainty.
That's right, and it's not a crazy statement to say that at the moment uncertainty is much higher than it normally is. Although, as you introduced the conversation, it always feels uncertain, but hence why that index is actually quite useful, because it helps put a figure on it basically and say, no, actually, now it is actually more uncertain than normal.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners and Burke Britton Financial Partners.
Welcome to another episode of Finances. Again, comes around quickly, but another quarterly update with JT from InvestSense. So I think every time we've caught up, we've said it's been an interesting quarter, even though this one probably, I think, might take the cake for the most volatility and the most conversations that we've probably had in our meetings with clients about the market. So I suppose we should just jump straight into our normal sort of proceedings, and that always pretty much starts off with what's happening in the US, and then what's everyone else thinking about that. So welcome, JT, and thank you.
Thanks for having me, Ben.
What's happening over there? What's going on, without mentioning a certain person's name? What's going on in the
US? For sure. So that's part of the difficulty is we have to try to zone out from a lot of the noise and the politics, and try to focus on the economic situation and the very little data that we have, but we have some data, and so it should allow us to make some small progress today. I'd say although I just said we should zone out the noise, the noise itself is having an impact. The Federal Reserve, the central bank in the US, started publishing this policy uncertainty index, and it is showing its maximum reading. It's the highest reading since the pandemic, right? So remember, at the height of the pandemic, when we really didn't know what the governments were doing, were the borders open, did we have to stay in, and all that stuff. The level of policy uncertainty has reached the same level today, which means that if you are, number one, a business manager of any sorts, then you're finding it very difficult to make investment decisions. Should I invest in a new plant? Should I hire more workers? Are my workers going to turn up? Are they going to be worried about immigration, etc.? And even as consumers, we're all impacted by this, and I mean, not all, but particularly in the US, it is impacted the US consumer. And therefore, all of it together is in itself acting as a slowdown on economic growth.
And probably the biggest thing with any marketplace, or even just if you think about people in their own individual circumstances, is uncertainty drives concern, and that's when people start to be again, uncertainty around that, and they don't.
Absolutely.
Don't like it. No one likes it, so markets react to that uncertainty.
That's right, and it's not a crazy statement to say that at the moment uncertainty is much higher than it normally is. Although, as you introduced the conversation, it always feels uncertain, but hence why that index is actually quite useful, because it helps put a figure on it basically and say, no, actually, now it is actually more uncertain than normal.
It's really interesting. Again, there's an index and a guide for most things, but something like that is obviously crucial to looking at markets, and you're not trying to justify it, but just sort of understand what's going on and sort of understand in a different time. And I think, again, probably the most topical term, and it was in our last conversation too, was tariffs. And it gets thrown around still. People sort of coming to terms with that, do you think, or is that still a big part of the uncertainty?
No, it's definitely still part of the uncertainty, because until tomorrow in Australia time, Liberation Day, April 1st in the US, we're going to actually find out, hopefully, what tariffs are going to hit which countries, and hopefully that, although it could be painful, should help put some of the uncertainty behind us. Although I have to say on that front, probably wouldn't want to be too ambitious, because tariff wars are by definition, one country puts on a tariff, another one retaliates, and then there's a counter tariffs, and going both ways. So I would be surprised if this is the last of it, but at least it would help us starting to be able to quantify it, because a lot of numbers have been thrown around and we don't really know what we have to deal with. So I probably want to mention three key things there. One is, yes, tariffs in and of themselves are inflationary. And for the reason that I just mentioned, it is not necessarily right to think about it as a one-off, because there could be other tariffs and counter tariffs, etc. So to the extent that there's one set of tariffs coming in and that's it, then it's a one-off for the inflation. But given the context, that's not a reasonable assumption. The extent to which tariffs are inflationary is also interesting. So I'll give a quick example. Let's say we are an importer of Chinese good into America. So I import iPhone covers that I buy for $1 in China that I resell for $10 in the US. If a tariff of 25% is put on, it means that my input cost goes from $1 to $1.25. It's not the end price that goes from 10 to 12.5, right? And therefore, as a reseller, maybe I'll decide to take the hit on the margin and not necessarily increase the price by 25 cents. Or even if I do decide to increase the price by 25 cents, it's not 25%. It's 2.5% in this case, right? And hence why the impact of tariffs on inflation is unlikely to be anything close to the number on the tariff itself, right? If tariffs are up at 25%, it's not all prices going up by 25%. I think that's an important distinction to make. A few other things that we can tell. Number one is if you look at the economic data on world trade, world trade has been quite flat for the last 6 to 12 months. In other words, it's not growing very fast, and therefore anything that will impede world trade, like tariffs, is likely to have a dampening impact on the growth of trade, right? So overall, the point is we're not starting from a particularly strong position from a trade perspective, and therefore tariffs are quite likely to have a recessionary impact on trade, not necessarily on the whole economy, but at least on trade. The second point is, if you look at the inventory data in the US, like how full are warehouses, they're pretty empty, right? So levels of inventories is pretty low, which means that the pass on from tariffs will be quite immediate. It's not like there's a whole bunch of goods sitting in warehouses that have been bought at low prices. It's as soon as the tariffs come in, it's going to have an immediate impact and be passed on right away. So I think those three things are the what we can tell for now. Again, trying to look at the data, look at the facts, and try to avoid the politics.
I think, and maybe when you're saying those things, you go, well, and not a lot of it makes sense for economic prosperity, but there's got to be a why behind why would they be implementing these things. So, again, in my simple sort of language, it's trying to bring manufacturing back into the US. Is that sort of the cut and thrust of it, or is there?
Yeah. Look, and I think the same could be said about a lot of the Trump policies, which is the why probably has some sense to it. It's the how that's questionable. In this case, I mean, this is not the place for a very long economic history lesson, but the economic model of China and most of Asia is very different to the Western economic model. In the West, we have what's called a profit maximizing system. The goal of companies here is to make a profit. The economies in a lot of Asia are employment maximizing, if you will. The goal in a non-democratic state like China is for the business sector to employ as many people as possible so that they have a job and they have something to eat and they don't revolt against the power in place, right? And so this is not a judgment in terms of which economic model is better. Each is suited for different situations. The problem is when you try to mix those two models together, and that's what happened when the World Trade Organization included China in 2000 or 2001. And now we've got those two very different models trading with each other. And what happens is when it comes to manufacturing goods, the non-profit maximizing model, being China particularly, wins out because they can afford to subsidize their product because they don't care about making a profits, and therefore by nature they're going to produce good at a cheaper prices, and therefore the industrial base, the manufacturing base of the US or of Victoria for that matter will be destroyed in the process. So the fact that Trump would like to rectify that wrong is logical. It's more in the how he's doing it, and the expectations also of like, if you're trying to bring manufacturing back to a country, it takes decades, not months. And maybe tariff is a good place to start. But again, how are they implemented matters as well. And the more certainty and the more time you can take is probably better.
I think that's the key part, is the speed and the probably the outlandish nature of how it's communicated is more so the part of it that creates the headlines and creates the uncertainty and creates the conversation and concerns, isn't it? It's more about just the method of implementation rather than the actual the process and the purpose behind them.
Absolutely. Yeah.
With another, again, we'll move on from the US government after this, but talking about Doge.
Yes.
I say.
Yeah.
Again, just some commentary around that, and I think from, again, memory here is that you sort of made the comment that it seemed to be actually being effective relatively quickly, which was maybe catching some people by surprise. Maybe first of all, what is Doge, and then what are they trying to achieve with that?
And look, I think we can make exactly the same comment, which is it starts off with a good observation and a good idea, and then the question mark is on the implementation. The observation here is that the US is running a fiscal deficit that is way too large. So the fiscal deficit was large before the pandemic. One could argue became a lot larger during the pandemic, and more surprisingly, hasn't closed since then. Right. So it is okay for governments to spend money when they absolutely need to, to get the country out of a recession, for example. It is more problematic for governments to be in a deficit when the economy is booming, as has been the case in the post-pandemic era. And so, in a way, the US was an unsustainable path when it comes to its spending, and something had to be done. The way in which it's being done, I would say, is the question mark. Is it being done too hastily? You want to cut fat, you don't want to cut muscle, right? Like that's and it's true for when you're cutting costs at companies. It's true when you're doing it in government services. And I don't know, but it may be the case that they're doing it too fast. What's been happening again on the data side is that it is having an immediate impact, and we can see it. The level of spending of the US government has gone down by hundreds of billions since Trump was inaugurated, which is significant. Interestingly, and we follow the data week to week, it has kind of bottomed, right? So they were able to cut about 400 billion of spending relative to where spending would have been last year at the same time. But now it's kind of leveling off. So maybe they've picked all the low-hanging fruits. Maybe the efforts of the courts, of the judicial system to slow down some of Elon Musk's efforts is working. Be that as it may, it seems to be slow down a little bit. The implication for the economy right away is that it's not good from an economic sense to spend too much money for the long term. But in the shorter term, it's actually having a pretty good impact, which is it's putting more money into people's pockets that they can spend. And so if you take that money away, then again, people have less money to spend, right? So we're seeing that happening in the US, where retail sales are slowing down as the government spending is being cut. And that, together with tariffs and world trade and high levels of uncertainty, all of that combined could potentially have a slowing down impact on the US economy. I think it already is starting to happen.
I think with that too, again, you're seeing that impact immediately, and maybe just sort of, and again, only briefly, what's the upside of the positive story potentially through the back end of this year and beyond, and what sort of the downside. So maybe on the downside first, like what would that be? Is that we continue to have uncertainty, we continue to have some issues in pushing forward, and we do potentially get some inflation bouncing.
So I think the downside, if Doge is successful, is a recession, right? So you cut government spendings too hard, too quick, and you slow down economic activity to the point that you get a recession. Like that's the downside. The upside is if you're able to balance those two things, so cut spending and primarily cut it from areas that were not productive spending, whether it's fraud or lack of productivity in certain areas of government spending. If you're able to cut that, then it has a real beneficial impact on the economy because, as I said, you're cutting fat, not muscle. The economy can continue to grow, and actually, government is being more productive. So that's a win-win.
Awesome, perfect. I suppose, how has this affected, going a little bit closer to home here and overlaying with the Aussie market a little bit? We've sort of probably just maybe suffered from the back of this uncertainty. It's flowed pretty much directly on a daily basis into what's happened on the Aussie market. But how have our portfolios held up through this period, and what did we have in place in advance of this? Not predicting it would happen, but sort of reading the data a little bit that there was a risk associated with the current trends.
Yeah, so we're definitely feeling the impact here in the Aussie market from a stock market perspective. The share market, the ASX 200, 300 is moving in tandem with tariffs on, tariffs off. All the news in America, and absolutely. I will say though that from an economic perspective, we're not yet seeing the impact here in Australia. Inflation is moderating, and that's good. We are also having quite a similar but not related increase in spending in governments. We are in pre-election time, and that tends to be the case. And that's flowing down into consumers' pockets and allowing them to spend. Rate cuts, we've had one, maybe we'll have another one or another two during the year, but it's not clear. Overall, the economic growth and inflation all seem to be ticking along more or less in the way that the RBA intended to, which is positive. Now, I will say that pretty much since the pandemic, we've kind of been 6 to 12 months behind the US in terms of the economic cycle. Maybe because we were locked down by an extra 12 months, I don't know. So if that's the case, and we're starting to see an economic slowdown in the US, it could be the case that we will see one in 6 to 12 months in Australia as well. But for now, that's not the case. To your question as how the portfolio is doing, yes, to some extent, this is an environment that's actually, in a relative sense, and I have to make that distinction. There's difference between relative and absolute. Absolute is, is the number up or is the number down? When all markets around the world are going down, it'll be very difficult for the portfolio to be up, to be in the green. However, what we can do is to make it go down by less than the rest. And that's what I mean in a relative sense. So in a relative sense, the portfolios are doing quite well. The reason for that, as you hinted to, is not at all because we predicted the tariffs and Doge and everything else. It's more because we're guided by valuation. So what I mean by that is we look at what's expensive, where is the risk priced in and where it's not. And it was clear to us that US equities were what we called priced for perfection. Yes, they are, NVIDIA and Amazon and Microsoft are unbelievable companies growing their earnings very fast, etc. But they're priced for perfection, meaning everything needs to be right for them to continue to maintain these levels. Whereas we looked around a lot of countries, and in our view, there were elevated risk, right? So they are elevated risk. They're not priced into current share prices, and therefore the risk-return relationship is not particularly to the advantage of investors. Whereas we look at other parts in the world, in Europe, for example, but also in Japan and in emerging markets, where we thought there was more attractive risk-return relationships. And so what we do in this case is we tilt the portfolio. It's not that we don't invest in the US at all, but we invest a lot less of our international equities exposure in the US and we put a lot more into Europe, Japan, and emerging markets. So far this year, it has worked very well. European equities have outperformed US equities by 20% in just 3 months, and really undoing the trend of the last few years. It's just the beginning of the undoing, if you want. Like, got a long way to go. Why is that happening? A few idiosyncratic reasons. The fact that Europe is refocusing from a defense perspective, refocusing on itself internally, increasing their defense spending. And so you've seen the share price of European defense companies really take off, and that's kind of led the whole market. So yes, in a way, it is related to Trump and NATO and all of the geopolitical stuff that's been happening since Trump was inaugurated. But at the same time, and again, it's not something that we predicted, it's more, we see a valuation discrepancy. One country is quite expensive and the other one is not. We don't try to predict what will close that discrepancy. It could take a while, but for us, it's a bit like gravity. Ultimately, it will reassert itself, and that's what we are beginning to see now. It's very short-term data. It's only been 2-3 months. It could reverse, but from our perspective, it does make sense.
I was going to say the key thing I'd written in front of me was just data, and using the data and using the analysis piece rather than emotion to drive these decisions. And that's always what it's about, isn't it? Essentially, if you can strip out the emotion of it, which is the challenge. People are emotional, humans are emotional. So, looking at your data set and looking at the valuation dashboard, you can clearly see for a long period of time that US equities were, you weren't getting compensated for the risk associated with a downturn. Now, as you say, again, short-term reaction, so let's not be too... we won't pat you on the back too much just yet. We'll give it a bit more time.
Exactly.
But I think the key thing is using that data, and then the very simple thing which clients love to hear about is just diversity, like how much diversity of the portfolio we do have, which stacks up well. Europe has been a little bit sort of on the nose for a while. Like, no one was too excited about Europe, but you need to continue to have exposure there. And then when things do start to turn, then you can reap some rewards out of that. I was going to ask you about why Europe has sort of increased, but I think that you've probably answered that already. The other one that has been topical, and it's probably been in the news a bit, and people like talking about it, is actually gold. And I think I had a client just yesterday said, "Oh, gold's done nothing for like 10 years, hasn't it?" And I said, and we looked at, I pulled up a graph and showed him, and he was a little bit surprised at what had happened in the last 12 months. But he probably wasn't too wrong about the period before. There had been a fair bit of time where it had traded sideways. But like, why gold at the moment? Like, what's driving?
So it's hard to say why the price of gold moves, generally speaking. I think in this particular case, and as you pointed out, the price of gold, I think, is up 45%.
Yeah, it's about 43, I think, yesterday when I looked at it.
In the last 12 months. Yeah, that's right. So there is actually, not to overemphasize the data aspect, but in this particular case, you can see that central banks around the world, and particularly in countries that are not necessarily aligned with the United States from a geopolitical perspective, their central banks have been increasing their share of gold holdings, of gold reserves. They've been buying more gold. So you think of China, Russia, and a lot of other countries, essentially seeing what happened to Russia, meaning start of the war in Ukraine. US is definitely on the side of Ukraine and against Russia. And so the US, together with Europe, is putting on economic sanctions on Russia, and which means that Russia, as a central bank, has a lot of US dollar reserves, US dollar treasury bonds that they now cannot use, and that they've essentially, for the time being, lost. Whereas, if they had those reserves in gold, this is actually something that they can use, right? That sits outside of the US financial system. And so you've seen a lot of other countries, mostly China, thinking, well, if we ever get into a tricky situation with the US, it would be useful to have less US Treasury bonds, less US dollars, and more gold. And so it's been gradual, but fairly consistent over the last 12, 24 months, that a lot of central banks around the world are buying gold. And I think that's contributing, maybe not the only reason, but contributing to the rise in gold. I think overall, there's the more the US government is in deficit, the more it needs to fund that deficit by issuing debt, the more essentially, if they issue too much debt or if they use the printing press to buy that debt themselves, then it devalues the dollar currency, the US dollar currency, or at least it makes people wonder whether at some point the US dollar will devalue. And therefore people look for safe assets outside of what has been so far the reserve currency of the world. Then people started, what else could be my reserve currency or my safe asset? And it's probably not the euro. It could be the Swiss franc, but it's too small of a currency. It could maybe in some instances be the Japanese yen. But overall, people converge to gold. And I think that's been a big reason why the price of gold is up. As you know, in our portfolio, we do hold a little bit of gold, a few percentage points, which we've rebalanced down a few times. In other words, we've taken profits on, and now we've kind of, maybe not taking profits anymore. We're kind of letting it run a little bit. So we've definitely taken profits along the way, but what we have left is continued to grow. And I think we're keeping it because that whole idea of uncertainty is still with us. And in that environment, gold could be a nice add-on to the core holdings of the portfolios.
Awesome. Again, diversity plus, like having that in there again is something different. I know clients love hearing about gold. I don't know why. It's one of those things that fascinates people. So we'll continue to keep you updated on the gold price. Probably rolls in well to other portfolio changes. And I think broadly, it's not about being too reactive in these times, which is what sometimes the thought is that you need to really, fully adjust or pull a massive portion or swing one way or the other on the theme. Now, again, the philosophy, as you would have definitely picked up throughout here, is just using the data to drive decisions and make incremental changes over time. And I think our broader weightings of the portfolio, growth, defensive, are tracking quite well. But we did have a couple of small changes in amongst the direct equity space. A couple of top-ups, a couple of new ones coming in. So again, without going into the micro detail, just give us a quick overview of what we can see coming through.
Sure. So look, the main changes is we're selling out of one particular stock, Breville, which is now famous for making coffee machines, appliances generally, but they've really hit their strides in Australia and globally with the coffee machines. It's a great company, very high quality. There's really absolutely nothing wrong with it, but it's also being reflected in the price, and it's now become quite expensive. A lot of future growth is already priced in. And once again, it's similar to what I was saying earlier with the US, it's kind of become a little bit priced for perfection. And we think there's better value elsewhere. So it's a fantastic story for the portfolio, one that has been very profitable, but we think that going forward, there might be greater opportunities elsewhere. That said, because there's nothing wrong with the company, if the price were to come off, there would definitely be a target, something we would want to revisit at a more attractive valuation, right? What's replacing Breville is two companies, Collins Foods, which is the KFC restaurant.
Just keep it simple. Just call it KFC.
KFC. Okay. It's called Collins Foods, but it's essentially the franchise of KFC restaurants in Australia. And they had a few other stores in a few other markets in Europe and elsewhere, but it's mainly Australia. And the fast food business, I think it's called Quick Service Restaurant, QSR, is still growing very, very much. And KFC is still at a stage where they're opening up a lot of new stores. So that kind of the sector itself is growing. Plus, you've got the benefit of new stores opening. So quite attractive growth rates. And it became fairly attractive from a price perspective. So you have nice future growth. And because it disappointed on earnings a few times, the price had come off a little bit. And we thought that was an attractive entry point. The same more or less with Integral Diagnostics, which is an imaging business, so X-ray, CT scans, etc. There's a few of those businesses in Australia. A lot of them have been bought out by private equities, similar situation where because of rising cost in employment post-COVID, wage growth, etc., their margins have been compressed quite a lot. Now they're in a position where they're more able to pass on those increased costs onto consumers, and actually consumers themselves being repaid more by the government, and therefore, like the future profitability of those companies is increased. And again, it was a function of the underlying trends, aging population, etc., speak to that part of the healthcare sector. It is attractive now at a relatively good price because it disappointed on earnings earlier. And it may not be that we're picking the absolute bottom, so maybe you have to be a little bit patient with those two, but they do provide us with quite attractive growth prospects in the future.
Awesome. I think just a little point just back on Breville, and I think sometimes people can get caught up on this, is that we're probably not selling it when it was at its absolute all-time high price, but relative to what you would be switching it into is that we made a really good profit, and you're moving into something else that appears much better value at the same time. And I know that's just more of a functional thing that often people go, oh, why would I sell Breville now? It's come off a few dollars. Well, it's still a hell of a lot more than what we paid for it originally, and we're still in a much better position moving sideways into that as well.
It's very hard to buy the low and sell the highest. So I think we're selling 10% off the high, which in as you say, what we have to see is where we bought it, where we're selling it, what the valuation is, right? Like, is it still expensive, even though it came off by 10%, and we think it is, and we're finding much more attractive opportunities elsewhere, as you said. Yeah.
I think with that, like, it's say off 10%, there's many others out there that are off 20 plus. So, relatively it's held on pretty well. I think only we'll just briefly touch on these other two because they've been topical names. Was a little bit of a top up into CSL and Min Resources as well. So just a little bit added in. So already existing holdings. I think CSL again it's come off probably again maybe 15% give or take, maybe a touch more. So again, quality company that we're just adding a little bit more to while the timing looks nice.
Yeah, no, absolutely. So I'd say CSL and Minres are kind of an opposite side of the spectrum. CSL is a very large cap, high quality company that for a variety of reasons continues to disappoint investors since COVID. We think a lot of those things are, it's a little bit of bad luck as well as a succession of things that happened that are not necessarily related, but have added up to disappoint investors. The core of the business is unchanged. Still remains high quality. There's still a lot of growth in that business, and so it's still fairly attractive. So very happy to top that one up when it comes off a little bit. Mineral Resources, completely different story. It was a very small weight in the portfolio, the absolute minimum weight, and I don't use that term often, but it was a little bit speculative in a sense that it was kind of a high risk, high return trade, and there as well we knew that it was going to be very hard for us to buy the absolute bottom. We waited 12 to 18 months for the stock to derate. So the stock went up amazingly when lithium prices were high, and then as lithium prices fell, the stock came off, and it happened at a bad period of time for the company because they had borrowed a lot of money, so a lot of debt in order to invest in a new mining project, not in lithium, in iron ore. And then they had a governance scandal with the current CEO, etc. So all those things kind of added up, and hence why the price came off a lot. That's when we decided to buy it. It wasn't the bottom, as it turned out. But we looked at the situation, and basically it hasn't changed drastically for us. It's still high risk, high return. If the company is successful, and really I think we'll find out, like by this time next year we will know if they're successful in ramping up their big iron ore mine that is now in production, right? So they need to ramp up volumes. Then they will be able to use that immediately in order to pay down the debt, and that will de-risk significantly that company. And I think at that point, investor will be much more comfortable coming back in. So yes, we've topped it up a little bit, but it still is a very small weight. And you have to think about it as, high risk, high return.
I think broadly, I'm not sure if they broke through $100 a share, but they got very close to that not that long ago. And I think we're buying now in the mid 20s, low 20s. So again, to give some people some idea on, there is volatility in that stock.
Yes.
Small portions, nibbling away a couple of times. Like, it's really the fundamentals of what we would be have been doing for a long time. So again,
but it's important to keep in mind that we have that stock together with a lot of other stocks that are much more stable, right? Like we want to be diversifying not just in the number of stocks, but in the type of risks that we're taking. And we have some stable companies who are paying dividends, and we have some more growth quality companies that are a little bit more expensive. Then we have some things at a few at the other end, which are a bit more speculative in nature. But it only works if you have all of them together.
We were talking about this with a client yesterday, that even in a growth-orientated portfolio, you'll still have dividend-paying stocks, and in a dividend-paying, in an income-focused portfolio, you still have to have growth-orientated stocks. So it's just about having a tilt, not an absolute bias towards it. So that we need to be still trying to grow, not just purely generate income in those income-focused portfolios. I think that's a good wrap on things. I think for people listening, make sure you send in your questions. We do this obviously quarterly. If we have questions coming in, especially in these times, then we'll happily jump on and do a short little recording while making JT commit to that anyway. So I'll put that on him. So send your questions in, and we're happy to run through any of those, whether we can answer them in-house or get JT on to answer any of the technical stuff. Thanks again, mate, for coming on. It's always good.
My pleasure. Thanks for having me, Ben. And see you next quarter. Bye.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at BurkeBrittonFP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility. Do your homework. Ask questions and speak to an actual human that knows what they're talking about before you do anything. PP Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.